Hey guys, Breezy CPA here, your certified public accountant, back with another video. In this video, I came across this article discussing private equity acquisitions of accounting firms and whether or not it's a double-edged sword when it comes to these acquisitions. So basically, this article discusses the rise of private equity firms buying up accounting firms and the consequences and the repercussions that can result from this happening with the economy and the accounting industry as a whole. Basically, private equity firms, if you don't know, they're firms that raise large pools of capital from investors and high net worth individuals. And they use that capital to acquire businesses with the intention of increasing profitability of those businesses, scaling those businesses, and eventually exiting via a sale of those businesses with an IPO. So this usually happens within a 3 to 7 year period. So they buy the business, they try to scale it, they upgrade it, they infuse capital within that business, and then they try to sell off that business for a profit. And the success of these private equity firms really depends on this quick turnover and this aggressive influx of capital into the company, increasing the size of the company, growing that company, and then selling it off for a profit. So this model works in a lot of different types of industries, including consumer products, restaurants, retail stores, and even the healthcare industry. But the question comes in relation to the accounting industry, because accounting isn't like a lot of other industries, especially auditing of financial statements is a public good. So it's built on professional skepticism, on independence and regulatory compliance. Unlike a lot of these other retail businesses or restaurants, auditing serves a public service in that the financial statements of a company really dictate what the markets do as far as people investing in those companies. So when it comes to auditing the financial statements of a company, it's really important that you have transparency and that you're deliberate in what you're doing. So the pace has to be deliberate and slow, and it's meant to catch mistakes and ensure the safety of the shareholders and the investors. And the financial markets are based on the trust and the credibility of the financial statements of companies for investors to make their informed decisions and to decide whether they want to invest in those companies based on the confidence that they have in the financial statements and the numbers that are presented to them by these audits. So private equity promises accounting firms capital that they have recently been struggling to obtain. And that capital could be used to modernize their outdated accounting systems or to deploy, cutting edge artificial intelligence. They can centralize the operations of these accounting firms, and they can even roll up multiple smaller accounting firms into a bigger accounting firm, a consolidated entity, making it more competitive in the industry. So, in an industry that is increasingly strained by a shrinking talent pipeline. So we've discussed this in previous videos where there is a shortage of CPAs and accountants coming into the industry. There's been digital disruption with AI, and there's an aging leadership class. We discussed that 75% of the current CPAs in the industry will be retiring within the next 10 to 15 years. So there's going to be a lot of accountants leaving the field within the next decade or so. So this infusion of capital into the accounting industry is a resource that can feel like a lifeline for a lot of these accounting firms. But the reality is that private equity and the core principles of auditing, which are again independence, skepticism, long-term accountability. They could be misaligned when it comes to accepting these offers from these private equity firms. And if the accounting profession doesn't proceed with caution when it comes to these private equity firms, it could find itself trading off this short-term growth for a long-term disaster and potentially jeopardizing the credibility that accounting firms have within the markets, the economy, and the accounting profession as a whole. So we're going to take a look at this article. We're also going to take a look at some comments from employees and people within the industry to get an idea of what this is going to mean for the accounting industry in relation to these private equity firms. So taking a look at this article, private equity acquisitions of accounting firms, are they a double-edged sword? Private equity acquisitions of accounting firms have sparked a contentious debate in the industry, offering a mix of opportunities and challenges. The auditing profession in the United States is experiencing a seismic shift as private equity investment flows into public accounting firms. For some, this trend signals a new era of modernization and growth, promising an infusion of much-needed capital, while for others it represents a direct threat to the foundational principles of audit quality and independence. As CFOs and financial executives watch these changes unfold, the stakes are high. How will this influence the integrity of financial reporting and the efficiency of capital markets? So these are very important questions here. How will these private equity firms acquiring accounting firms affect the integrity of financial reporting and the efficiency of our capital markets? The case for private equity investments in public accounting firms. Proponents of private equity investments argue that the influx of capital could be a game changer for the auditing profession. Historically, auditing firms have struggled to secure financial resources needed to make significant investments in cutting-edge technology, staff training, and strategic acquisitions. So this is definitely something that could help accounting firms in that they are going to be getting this influx of capital to help them with their technology and staff. Private equity funding opens doors to advancements like artificial intelligence in auditing, which could transform the accuracy and efficiency of audit processes. Advocates emphasize that these technological upgrades are not merely luxuries, but an essential tool for the evolving financial landscape. And that's for sure something that is the future of accounting, especially with artificial intelligence. There are going to need to be technological updates within the industry. And of course, for those technological updates to take place, you're going to need to have a substantial amount of funding involved. So that is what private equity can offer to these firms. Additionally, private equity investments provide opportunities for operational efficiencies that are difficult to achieve otherwise, a significant advantage of a roll-up strategy where smaller accounting firms are consolidated into a larger entity, and that provides the opportunity to centralize audit tasks by leveraging shared service centers in lower cost offshore locations. Private equity backed firms can reduce costs and improve the consistency of the service quality. So, for instance, components of audit engagement execution, such as data processing or routine testing, can be standardized and moved offshore. This not only drives down the expenses, but also enables audit teams to focus on more value-added activities, ultimately benefiting both the firm and its clients. Moreover, advocates argue that private equity brings a level of discipline and strategic focus that traditional accounting firm structures often lack. With dedicated resources for implementing large-scale change, private equity firms are poised to accelerate growth and improve operational effectiveness. The Wall Street Journal, for example, has reported on cases where private equity investments facilitated the development and advancement of data analytic platforms, enhancing audit precision and enabling firms to offer better insights to their clients. From the vantage point of the private equity fund, investing in accounting firms represents a highly attractive opportunity in that the roll-up strategy can unlock significant returns from investors by consolidating fragmented markets, achieving economies of scale, and optimizing operations. Also, something to consider is that a lot of the private equities have already infiltrated a lot of different other sectors in the economy, and they're not left with many other options in what they can invest in. And the accounting industry is one that hasn't generally been touched by private equity up until recently. So this is one of the few areas that they can now invest in. As previously mentioned, shifting parts of audit execution to shared service centers in offshore locations, so on. The efficiency gain can be translated into higher margins, making the investment more profitable. And that's the issue here, is that private equity is concerned only about profit. They're mainly concerned about growing these companies, making them look profitable, and then eventually selling them off to make money for their investors. And that is an issue when it comes to accounting, because accounting, again, is a public service. It's a public good. And when you're mainly concerned about the bottom line and making profits and not about the quality of the work itself, then that can jeopardize the accounting profession potentially. So furthermore, private equities firms see accounting as a relatively stable and predictive industry, especially on the audit side. The annuity-like income stream from audit and tax compliant engagements provides a financial foundation that can be supplemented with higher growth potential of advisory service. An article in Bloomberg highlights how private equity firms have used this model to rapidly expand their advisory offerings, capitalizing on demand for consulting services while maintaining a steady audit revenue base. So the accounting industry is appealing because obviously the accounting industry isn't going anywhere. Everybody needs accounting services, especially the major corporations. Everyone needs their financial statements audited. Everyone needs to do their taxes on a yearly basis. So for private equity firms, they know that this is a stable business and a stable industry. The argument against private equity firms. So the inherent risk to audit quality, this is one of the major concerns here when it comes to these private equity firms. Critics present a starkly different perspective, emphasizing the risk to audit independence. The core concern lies in the private equity model itself, which prioritizes short-term returns and profitability. Private equity-backed firms may feel pressure to prioritize high-margin advisory services over more methodical, less lucrative audit work. This shift in focus could lead to a reduced investment in audit quality and even incentivize practices that jeopardize auditor independence. So if you're looking to make money quick and streamline operations, and you're not so concerned about the details of these audits, then you are essentially compromising the audit itself. The threat to auditor independence becomes particularly pronounced when considering the interconnected nature of private equity ownership. Private equity firms often manage a broad range of portfolios of companies across various sectors, creating potential conflicts of interest. So these private equity firms, they buy all sorts of different companies from all sorts of different sectors. And so, for example, here, if a private equity firm has a portfolio that includes a technology company that offers financial reporting software, and that software is used by audit clients of the private-backed accounting firm, then that poses a clear risk to the credibility of that audit. Even if there is no direct influence, the perception that these relationships could impact an auditor's objectivity can erode the public trust. And trust is the most important thing when it comes to these audits. As an accountant, you have to take an oath, an ethics exam. to make sure that you are complying with these ethical standards of the profession, because the public trust is so important when it comes to financial statements and auditing. Such concerns are not theoretical. Regulators in the UK have raised red flags about these arrangements, and the Financial Times has reported on instances where audit clients questioned the impartiality of private equity influenced auditors. Additionally, critics point to the broader implications of private equity ownership. According to an article in Accounting Today, there is limited evidence to suggest that firms with private equity backing have significantly reinvested in audit quality. So we don't know that that's going to happen for sure. Instead, funds often appear to be channeled into expanding advisory services through aggressive acquisition strategy. This not only shifts the focus away from auditing, but also exposes firms to heightened regulatory scrutiny. Furthermore, the skeptics argue that traditional capital markets often offer an alternative for audit firms seeking capital. Borrowing or other forms of financing do not come with the same risks of influence over governance and priorities. So they question why equity investments, with all of their associated conflicts, should be necessary. The overreaching concern is that no governance structure can fully insulate the audit function from profit-driven motives, leading to potential decline in audit rigor and credibility. So there's definitely some major concerns here when it comes to these private equity firms and their interests in making profit as opposed to the quality of the work that is being done, and the conflicts of interest that can arise with the portfolios that these private equity firms hold. The perspective of regulators. Regulators have not been silent on these developments, and their concerns reflect broader anxiety about the evolving audit landscape. Senator Elizabeth Warren has been a vocal critic of the Public Accounting Oversight Board, arguing that it has failed to effectively enforce audit quality standards. In a 2024 statement, the Public Company Accounting Oversight Board must step up and address the growing influence of private equity in the audit profession before audit quality deteriorates further. So there's concerns from many different areas here. Um, According to the Financial Times, the FRC's new guidance reflects an increasing awareness of the potential risks associated with private equity ownership and commitment to maintaining higher audit standards. The decision-making dilemma for CFOs and controllers. Amid the debate, CFOs and financial leaders are left in a difficult position. The integrity of audited financial statements directly impacts the market efficiency and investor confidence, as we mentioned earlier. If audits become compromised, then trading volumes in the markets could decline and the reliability of financial reporting could erode. So this is huge because the markets depend on the reliability of these financial statements that are being audited by these accounting firms. So if you erode that confidence, investors may not be investing anymore. CFOs must weigh the potential benefits of working with private-backed audit firms, such as better technology and broader service offerings, against the risk of compromised independence and the possibility of having to reissue financial statements. Moreover, the broader context complicates the picture further. An aging leadership demographic in CPA firms, declining accounting enrollment, and the rapid pace of technological change have created an environment that is ripe for disruption. So these private equity firms are also feeding on the fact that there is this current disruption within the accounting world where there is this lack of capital. We have an aging workforce, and there's fewer people coming into the accounting profession. So, the private equity firms, they're going to be getting a better price for these accounting firms if they were to buy them. While private equity investments could address these challenges, the ultimate question remains, are these funds truly being used to bolster audit quality? Definitely not. So let's get this out of the way here. Private equity firms are not in this to increase the quality of the audits that are taking place. They might do that in the short term, but their ultimate objective is to make money and profit for their investors? Or are they fueling expansion into more profitable yet non-audit business lines? And that is basically what they're doing. The debate over private equity investment in public accounting firms is far from settled. Both sides offer compelling arguments, and the future will likely hinge on how well firms and regulators can balance innovation with an unwavering need for audit quality. As financial executives, the onus is on you to critically evaluate the dynamics, ensuring that your audit firm choices support not just immediate needs, but the long-term health of the capital markets. So this is a difficult discussion to have. Obviously, if you are in a auditing firm and you need the capital, and one of these private equity firms comes to you and says, "Hey, we're offering this huge influx of money," you may well be inclined to comply and sell off your auditing firm to these private equity investors. But in the long term, it's, in my opinion, not something that's going to be good for the industry, because private equity investment fundamentally is about making money, not about the quality of the audits or the accounting profession. They have diversified portfolios in so many different sectors, that their concern is not about the accounting profession and the quality of these audits. It's about making money and the bottom line. So let's take a look at some of the comments related to private equity from employees and people within the industry to get a better idea of what's going on. Before we get into the comments, if you're interested in learning more about accounting, becoming a certified public accountant, starting your own CPA firm, and then selling off to private equity for millions, make sure to visit breezycpa.com and check out our library of courses. We offer a full gamut of courses for the CPA exam and various accounting resources. So visit breezycpa.com, use promo code BREEZY20 to get 20% off your order at checkout. So starting off with this first comment here, everyone is concerned about AI or offshoring, but private equity is the real cause for concern. With the crap quality that the Big Four is producing, plus worker scandals, how long can they keep going? Will we even have a Big Four by 2040 if they're not swamped by private equity? And this isn't just for accounting. The quality of many, many things is declining in general. KFC was one of the first few victims where they tried to literally cut costs by removing some of the flavoring from the original recipe that they had. Everyone is concerned about AI or offshoring. There are two cheeks of the same arse. The ability to outsource and automate is exactly what's attracting private equity to accounting firms, and the AICPA just rolled out the red carpet for them by suggesting the future of accounting is fewer qualified staff overseeing work being done by others or by AI. It'll be the same in Europe too. Private equity firms are gambling on being able to retain enough quality and knowledge from the dwindling pool of talent to make up for the difference with these new delivery models. I'm not sure that they can do that personally. What are they saying here? Too much stupid hot money chasing too few assets. Take backcountry.com, for example. They went from one of the top outdoor retailers to being sold for pennies on the dollar to the third private equity company in the past 10 years. And there's numerous examples of these private equity companies coming in and basically ruining companies that have been around for decades. Other examples include Toys R Us, who was bought up by private equity, and they ended up acquiring something like $5 billion in debt, and they were drained for cash flow, and they ended up declaring bankruptcy back in 2017, and they were liquidated. Also, Payless Shoes was another one where they borrowed $700 million and paid out $350 million in dividends to its private equity shareholders. Hertz Rent-A-Car, another one where they were loaded with debt after a leveraged payout. They ended up declaring bankruptcy in 2020 after COVID. So there's numerous instances where these private equity firms come in and they drain the company, or they use it as a piggy bank where they end up taking out debt and basically paying off their shareholders and leaving the company dry. So that was the instance here with backcountry.com. Um, Continuing on, every time this pops up, I can only imagine a world where the AICPA lobbies to get legislation passed to block the private equity acquisition. So this is a big discussion as to whether the AICPA is going to be doing anything to try and block these private equities from acquiring these accounting firms. But I don't think that's going to happen here. Am I the only CPA who despises working for private equity owned companies in industry? Based on my industry experience, I'd never work for a private equity owned CPA firm unless it was my own. Why? Because you pay 1 to 2 times sales, merge to fewer and fewer firms, and increase prices and decrease costs. As long as your time horizon is long enough, it's stupid not to buy and roll up companies. So there's a bunch of different comments here, basically saying that this is going to be a negative impact on the industry. Um, what are they going to do with them in 5 to 7 years? Who's buying them then? Um, what's going to happen with the merger talent that wants to be promoted to partner? I hate to call it offshoring, but it's taking advantage of people less fortunate than us, or what we call capitalism. And here's one of the best pieces of advice. Why is everybody worried? Just start your own accounting firm, drum up business, sell to private equity, and make some profit. So if you guys want to do that, breezycpa.com, get started on your CPA certification, start your own firm, get the business, get the clients, and then sell off to private equity and retire with your millions. So let me know what you guys think of this issue here with private equity and accounting firms, them coming into the industry, purchasing all these various accounting firms, rolling them up, and basically creating an influx of capital, but potential long-term disaster. Let me know what you guys think in the comments down below. Thank you to all those who have subscribed. If you haven't already, please hit the subscribe button down below. Thanks for watching, and I'll see you guys in the next one.